Hi, Steve Van Metre here, and welcome to your weekly economic update. And I have a ton of stuff to talk about. We've got the trade war, we've got the Fed, we've got the markets, and then all of our usual stuff. And I've got an interesting thing we're going to touch on. We're going to spend a lot of time on gold. More and more people are coming out with bullish calls on it. They're saying there's going to be a pullback, and there's a ton of support under these gold mining stocks. I want to look at it because, again, this is a big narrative. Something big is shifting is starting to shift in the markets. Now, you wouldn't know that if you look at just the equities. You would see it. When you start looking at the big picture, you look at the bond market, you look at other sectors such as gold, you go, something is coming. But most people can't see it. All right, so let's start out with the trade war. The Chinese delegation came here this week. They're going to stay 2 extra days, and this is, wow, big deal. They're going to be here a couple extra days because things are going really well. Look, if things were going so good, we're now in week 2 of a continuous meeting. Remember, our delegation went to China. Now their delegation is here. Why can't we get a deal done? Well, there's some structural issues to this. And part of the reason we're not getting a deal done, not even over this weekend, is because President Trump said that he's looking to have a meeting with President Xi at Mar-a-Lago at the end of next month. So it kind of already tells us if they've got a deal they're not talking about, which, of course, anyone who's been following President Trump since he got elected knows that he likes to talk about anything, especially good news. But if it's bad news, he'll twist it and it'll turn into good news. So if there's something really good coming, probably would have heard that, but we didn't. So we'll see what happens over the weekend, but I imagine there are going to be tweets and whatnot of how great things are going. But remember, we're on month 7 of this, and nothing's gotten better. But I don't think they're really going to get to a deal. I'm going to stand by this prediction for a while. Or whatever deal we get is not going to be what the Trump administration wants. And the reason I say it is because I've been reading a book about the history of trade. It's really interesting. It goes back to pretty much the very early things that man was trading. And right now I got to the part where it's kind of the, say, late 1800s. I mean, it's pretty broad, I understand. But this is where globalization first began. And all of a sudden, there's a lot of trading going on all around the world. And the idea was the trade would lift standard of living up, right? So if I produce something really well and you don't, I would export to you at a lower price than you could create it, and that would raise your standard of living. And then you would export to me something that I can't easily produce, and that would raise my standard of living. And that was the general belief. At the time, it was like, hey, open the borders up, put ships and trade all over the place. But what happened was the opposite. Standard of living fell and wages fell. Sound familiar? It does. But what's really interesting, and I haven't really been able to dig too deep into it, but this place I left off the other night, that 2 people decided to start doing some research, and they concluded that global trade didn't work the way everyone thought it did. And when I took their kind of thesis of, okay, if you have, X, you need to go find a trading partner who doesn't have X. They might have Y and you're short Y, and that's a good relationship. And so they kind of said, here's kind of how the world looked like. These were the things that, certain countries really had, and here's what they needed, and here's what everyone else had, and here's what they needed. And you could kind of start drawing some lines and think, oh, you can kind of see these are the good relationships and here's the bad ones. And it made a lot of sense. So when I started applying their theory to what's going on today with China, I come to the really quick conclusion is the reason we have no trade deal is because what we're asking of China is more than they can actually do. If they actually broke down and said, yes, we will, quit stealing your intellectual property, which is stupid because American corporations are giving it to them, and they started importing more goods along with financial services that we're asking them for, they can't do it. It would really cause havoc in their economy. And what's interesting is I think they understand it, and I'm pretty convinced that we don't. So the reason this is dragging on is because China can't make a deal. The problem is now these tariffs really are affecting them. In addition to the Fed tightening world dollar liquidity, the tariffs really do hurt them. I mean, they hurt us too, but they're hurting them more at the moment. But our day is coming. We're not exempt from that. So while we're on the topic of the Fed, so again, I'll just stop with the trade thing and say, I don't think anything big's coming. And if we do get something, it's going to be a watered down deal to say, look, we're going to start trading these things and we'll eventually work on the other things, which will not be resolved. Again, remember, President Trump needs a win out of something, and he needs a win out of the Midwest. So the focus is going to be on the farmers because that's who helped elect him. And of course, why wouldn't he? If you're trying to get reelected in 2 years, you're going to want to help the people that put you in. So that's where anything's going to, in terms of success of a trade deal, it's going to be focused on the farmers. Now, as we switch over to the Fed, there was a laundry list of Fed speakers today. I mean, it's almost like every 45 minutes there was somebody talking about something. And it's like, well, it's kind of unusual that the Fed would just send this fleet of people out. Now, mind you, none of them were Jerome Powell. And I'm going to qualify this because I'm going to show you something really interesting. I know a lot of people think I've been kind of crazy saying the interest rates are headed to zero, but I'm going to show you the Fed has sent up a trial balloon today. They're saying that's, you can infer it. I know you're going to say, well, you're really digging deep here. I'm not digging this deep when you know where they're getting this idea from. They're getting it from Japan. So there was some talk today, and I'm not going to labor over some people. Some of the Fed speakers said the balance sheet unwind needed into this year. Others said it's not a problem. Here's the reality of how the Federal Reserve works. Jay Powell, the chairman, he calls the shots. This is how it works. Now you can say, no, that's not true. They're a board and they discuss this. Look, go read books about people that have been in the Fed or worked at the Fed and have talked about it. And they will say, look, in the end of the day, all these people can have different opinions. But the bottom line is what the Fed chair wants, the Fed chair gets. And this happened when Janet Yellen was chair. There were people that would dissent. But later on, you'd find out they disagreed with it when you get to the meeting minutes that are 5 years old that we were allowed to read. You can really tell there's a lot of disagreement. And then at the end, they're all voting with her. Well, why is that? Because in the end, the Fed chair is the FOMC board. So let's take a look at what I've got for you. This is really cool. And we'll hit the market and the disclosure. So here I'm on the Federal Reserve website, and here's a speech by Vice Chair Clarida. Now, this is a pretty high position. So, voting member, very high position in the board. So let's take a look at what Richard had to say. And somewhere down here where he's talking about these three questions, let's see if we can find it. I know they say you're supposed to have all this stuff lined up, but, it's kind of fun to look through it together and see. Let's see. Here we go. In addition to assessing the efficiency of these tools, so he's talking about the Fed's tools, that they believe they have even more tools than they really want people to know. We will consider additional tools to ease policy when the ELB, they're talking about the federal funds rate being at zero. So when they get to zero, they're kind of in a bind. So for example, as presently at Bank of Japan, this is all that you need to know when you get to this part. This is where they're looking for it. As presently, the Bank of Japan policy, the FOMC could, when the federal funds rate is at zero, establish a temporary ceiling for Treasury yields at longer maturities by standing ready to purchase them at a pre-announced floor price. Now, this is what's going on in Japan. Japan actually targeted an interest rate on their bonds, and so they drove them down to zero and said, effectively, anybody that ever wants to sell, here's the window. You just bring your bond and we'll pay you the value of it based on a 0% interest rate. That's what the Fed's going to do in the next crisis. They're going to get down to zero. So you already know they didn't get federal funds rate up high enough. They didn't get the balance sheet low enough. And when the next crisis hits, they're going to go to zero. They're going to do quantitative easing, which will destroy society some more. If it hasn't already enough, they're going to damage it some more and damage the economy. And then they're going to do what Japan did, and they're going to hold this thing at zero. And anyone who owns Treasury bonds is going to walk up to that door, hand them their bond, and cash in a big, big way. So I want you to think I knew this was coming, and there's a reason why I want to hold Treasury bonds, because this is what the Fed's going to be forced to do. And they go on to say, during the crisis and its aftermath, the Federal Reserve reviewed but ultimately found this tool and some others deployed by foreign central banks wanting relative to the alternatives it did pursue. But the review will reassess the case for these and other tools in light of more recent experience in other countries, which is fantastic. I guess I should have had that highlighted here. So here, I'll highlight that while I keep going on. But the idea being is now they're looking and saying, look, we don't have the tools to get through the next recession, so we might do this. This is really, really interesting stuff. All right, so let's get back to the markets and then real quick. So why the market's rallying? Because you had, which nobody knew, and we're starting to hear from the investment banks, that share buybacks are running at a 91% increase over last year. Now, there isn't a 91% increase in share buybacks. Based on what we know, there was about $1 trillion bought back last year. Early on, this was supposed to drop to about $800 billion. Some people say it's going to be over $1 trillion a little bit. Some people say it's going to be under $1 trillion. I'm going to say it's going to be under, because as the global economy continues to go down, these companies aren't going to have the money to buy all their stock back that they're projecting. I mean, it's just not going to happen. And it's weird that it's not weird. When you understand that these big corporations know the data ahead of the government, because they're looking at live. I mean, telling me Jeff Bezos cannot, give me by the minute results of what Amazon is selling. He knows, right? All these big companies, they know hour by hour, day by day, where they were from last year to this year and what's really going on. And the banks know how people, are they charging it? Are they spending? Where's the money coming from? They know all of this. So why are corporations just hammering this money in? Because they know when they get to the first quarter and then the second quarter, the data is going to look terrible, their stock price is going to fall, and these executives have got to get their money out now. This is it. This is the end of the line for them. So they just literally hammered this thing to the floor, just get these share buybacks going. And what's going to happen is last year they ran out of money in October and the market dropped 20%. At this rate, they're going to run out of money by the end of May if they sustain it. But just keep this in mind. The moment they pause for any reason, there's no money there's nothing to hold them up. All right. So with that, the content of this video is provided as educational information only. Is not intended to provide investment or other advice. This material not to be construed as recognition or solicitation to buy or sell any security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre, own personal capacity. Opinions expressed in the video that amount do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. So with that, so the money supply ticked up a little bit. I'm still not buying that the downtrend is over. Even though it looks like it's heading up, we know the Fed is still tightening. But the key is, even though the year-over-year rate ticked up, a tenth or 0.2% to 4.4, it's still historically very low. But the key is the 6-month rate of change is falling, as well as the 3-month rate of change, and that is all that really matters. Is those shorter-term growth rates are starting to slide. So we see the growth rate actually, that's not correct. That should say, how about this for revisionist history, right? Boom. Hey, there we go. Increased 15 billion to 611. Again, unsustainable as long as the Fed is unwinding. How much is this being controlled by corporations borrowing their money to buy their stock back? Unknown at this point. But here's the key. Everyone's whining about the monetary base. Asset prices now should be below their 2016 levels, and this thing is just bobbling along, and it will continue to go down. There's nothing really keeping this up other than the Fed continuing to tighten. So whether they stop at the end of this year, next year, the year after, or when the recession hits, it doesn't matter. This has not gotten deep enough, because again, here's quantitative 1, 2, and 3, and we're just nipping into quantitative easing 3. So we've barely gotten anywhere, leaving the Fed without much ammunition. On to commercial industrial lending, I'm amazed that this thing keeps nudging higher. It's 11.4%. The back end number now is rising to 1.22, and kind of going forward, this back end number is going to rise. So that ought to tell me, unless there's just huge demand, which I don't see in any of the Fed information, that there's strong lending demand outside, that large companies are borrowing money to buy their stock back, this ought to roll over and head down. Because again, this 11 looks really great, but when you compare it to where it was a year ago, which is why I put that number up there, it's not that impressive. Consumers still flat at 5.43% on their credit card growth rate. It's still decent growth rate, but not at this 8+% rate over here. We know this is slowing. We know consumer demand is slowing, and this ought to continue to go down. Along with the Federal Reserve balance sheet that they knocked down $47 billion for this week. So let me qualify this, that the coming weeks, this is probably going to head back up some, because they unloaded too big. They're over their target, unless they're going to somehow adjust this into February. Actually, I just noticed something. That has actually been saying January there for a while. So let's do some revisionist history here and fix that. So unless they were playing catch up from January earlier in this month, this is probably going to come back up a bit over the next week, and then will be into March. So I don't see this holding, but they're still on track. Again, no sign of the Fed pausing here. So anyone that thinks that, yes, the Fed is pausing, this is not a graph of them slowing down at all. Looking at total savings depository institutions was up to 1.53%, but still really low. I mean, just goes to show that households are in bad shape. They're not really growing their savings. And this probably, I mean, this hands down gets the chart of the week. And it's the only one, so it makes it really easy. This is the Ief Exchange-Traded Fund, the 7 to 10 year Treasury Bonds, as a record 9 million shares short. So people have borrowed 9 million shares to short this fund. And when I keep saying there's going to be a massive unwind and yields are going to drop, and when you see this, this tells you, yes, I'm going to be right. And that tells you that yields are going lower. Liquidity is going to get drained out of this. It's going to pull stock prices down. And this chart goes back to 2010. And you can see here in 2013, it popped up and gets hammered down. So we know that this thing's going to get unwound at some point. And I want to thank, I believe it was Bloomberg that put this chart up on Twitter, because it's pretty cool. Let's go take a look at the assets and liabilities at the Federal Reserve banks. And we've noticed the last couple of weeks these fell down, but they're back up this week. So here we are, Treasury and agency securities. As of end of last week, we are up $12 billion in Treasury bonds. So they've been buying mortgage-backed securities. They're up, looks like $11 billion, and non-mortgage-backed bonds are up $1 billion. So that's quite a bit. What about 24 billion or so, something like that? 25, somewhere right in there. So that's pretty interesting stuff. The banks are back buying. So let's still take a look at what they're doing. Let me clear some of the stuff off so I can actually see where we're at. Let's go over to the charts. Here we go. Now you can see, and here's the 7 to 10 year treasury. This is 10-year treasury yields, which mimics the 7 to 10 year the 7 to 10 year treasury bond fund mimics this. So here's the week ending February 15th. So what happened was the banks were buying right here. And then we got this little jump here. Short sellers came in, and we see this rejection today because we now have the information that shows the banks are back buying, so keeping yields down. And this is very interesting because here's the 50-day moving average. And we know rallies begin when they cross. Now, normally we're looking at rallies going up, but for Treasury yields, rallies occur when they cross downward through their moving average and when they're confirmed at their moving average or rejected. Now, we don't see them coming up and rejecting, which means they probably could at some point. They will at some point, but they haven't yet. But let's look at 30-year Treasury bonds. These are 30-year yields. We see that interest rates popped up, boom, boom, Wednesday, Thursday, closed over 50-day. Now, remember, they crossed here, came up, confirmed it, came all the way down, and are now retesting it as on Thursday. But look what happened today. They opened right below their 50-day and closed down lower. So it tells us, if somebody's thinking, well, there's no way yields are going down, we have the banks buying, which is bullish for Treasury bonds. We have the Fed tightening, bullish for Treasury bonds. I've covered that, repeatedly. And now from a technical perspective, we're seeing rejection at the 50-day moving average. Remember, there's a really simple theory. It says crossover, reconfirm, and your probabilities of this thing going are really good. Now let's go back and zoom out and look at again where we're at on these. We'll just zoom this way out, and we can see this is obviously a downward move in yields. It's consolidating here. It's not getting any upward movement. But when it crosses on the 10 years, it's roughly, I've been saying 2.6 to 2.625, just to give a little range here. And you can see every time it comes really quick, at least down to around 2.3. So we know that this is getting balled up to move down. Same with the 30-year. It's just consolidating right at this level right here at 2.9. We'll just say 2.9596. And again, you get a quick move right down here to roughly just right in around 2.7%. So we know that this thing's going to unwind. We can look at 5-year Treasury yields, and we can move my prior line down to here and see that when this thing breaks, 5-year yields are going right down to 2.1. So that has to pull these longer 10-year yields down to 2.3, and the 30-year yields, down to say 2.7. So we know this is going to happen. And I just realized you didn't get to watch any of the charts. Rewind. Sorry. I've been trying to fix that problem on my end, but I keep making the same mistake. Anyways, here we go. Real quick, 10-year Treasury. Sorry about that. I've been really working at fixing that, and it's one of those things when I turn the camera on, I know it's going to happen one of these days. Here you go. You see 10-year Treasury is consolidating right here at this big down move, not hitting its 50-day moving average, and it's got this move down to 2.3 right there. If we look at 5-year, we're consolidating right around this 2.468-ish right in here under its 50-day. It pulls down to around 2.1. And 30-year, it's confirmed here. I'll zoom in so you can see it. It crossed over the 50-day, got rejected today, pulled down. So this is now confirming that we are in a bull market for bonds. We'll zoom out. And 30-year yields are going to go up all the way down to somewhere around 2.7% when that happens. So we kind of know what is coming. All right, so let's go and take a look at the broad equity market. We're kind of here in no man's land between 2,800 and 28. What do I have this at? 28.16. You've seen every time it gets right into this range right up here, heavy selling, heavy selling, heavy selling, heavy selling, heavy selling. And so here we are again. And guess what is likely to happen? Yeah, everyone says it's higher, but reality is we're probably going to see heavy selling because there just isn't any news left to keep this market up. However, from a bullish perspective, we have 2 weeks closing over the 50-day, 50-week moving average. And that, in the past, that's pretty good indication. But you'll notice we're in this, again, this dead zone around 2,800. Let's go on and take a look at gold. So here we are, gold futures. We'll zoom back out here. And it kind of got up here, and I said, look, this thing kind of went too quick, too fast. It's going to get rejected. Every time it kind of comes shooting up, it pulls back down a level or two. So it tells us that gold could likely get down here into this 1240, 1250 range and still be A-okay. Now, today, as I wrote about, I watched an interview with Louise Yamada. She is considered one of the top technical analysts in this country. So we're going to take what she said and also in mind with Peter Brandt, classical chartist, and we're going to take a look at what they think is going to happen. Now, in her view, she said gold's going to, when it breaks out of this, it's got to get first to 1,400. Now, Peter's at 1,380. I think we're closer to 1,360. But all these people are right here in this range. And if we take this green line and split it both sides, 20 on each side, you've got it. Now, let's zoom out. She said, according to her charts, 1,500 is the first quick move and find support here. The next move, she said, 1,600. Peter Brandt's up here. Raoul Pal with Global Macro Investors, he says new all-time highs. We get out of this range and new all-time highs. And part of the reason some of these people are saying this is this chart pattern, and I'll go home and look over my books this weekend on classical charting that Peter Brandt recommended and that I bought, is this is a cup, starting to look like a cup and handle chart. So you have to use your imagination because I cannot draw a curve. So you have this going down, curving like the bottom of a cup, and it comes up, and then it gets rejected up here, and then it makes a little handle. So think of it like a teacup, right? It's got a little handle here. And this is a very powerful signal that when this thing breaks out to the upside, you want to look at being in it. So even Louise said, look, you can buy now. There's some downside risk. You got to watch for it. But, she goes, look, if you want the safe way, just wait till it gets to 1,400 and, buy. Because when it gets there, it's going to start to go. Now, obviously, we want to be in there first. But we don't want to take a lot of risk doing that because these things are pretty volatile. So let's go look here at the gold miners, and we'll zoom back out. Here they got rejected up here, and I kind of was expecting that. They went up too quick, too fast. So their initial support is very weak here at 2138. There's a little bit stronger support here around 20 where I think it stops. So there's much stronger support here. But let's look at these moving averages. We've got the 50-day, 100-day, and 200-day all providing support here. And when you look at rallies, the 50 days curving up, the 100 days curving up, and the 200 days flattening. This is a good sign. Let's go look at the weeklies. So we'll zoom in and look at right where they're at. Right here, we have the 50-week just over 2091. We have the 200-week at 21, and the 100-week right there at almost 22. So here the weekly moving averages are providing support. How about the monthlies? There aren't going to be that many because this thing, you're not going to see like the 200 month. But look at the 50-month moving average. You can barely see it kind of here. Here it is in green, and it comes right down here. Here's the 100-month, not as important, because if we look at the 50-month, we can see it's kind of telling us that when it's trending down, you're kind of in trouble. It's flattening. It's providing support. So there's a monster amount of support sitting under these. And I suspect we'll get a pull back down into here. That's where we want to buy, because we know when this thing breaks out, according to Peter's data, and I lined this up before, you get like 150% return-ish, somewhere in that neighborhood from here to here based on this pattern. I mean, it's pretty explosive. I mean, it's going to get to here, and once it gets through here, it's got not a lot of effort to get up in the 42s, and then from there, I mean, this thing probably gets lit on fire like a rocket, but that's the target. And if this thing breaks through there, I mean, now you get new all-time highs, but there's no telling where it goes from there. Let's go and take a look at the 7 to 10 year Treasury bonds, and we'll look at ags. And you know what? Let's look at oil and gas producers here. So there's a little different look. So you have downward trending 100-day moving average, downward trending 50-day. People are saying, look, this is really bullish. It's going to take off here. The reality is, no. This thing's got a retest of down here somewhere, and is finding resistance here. And it's not, you know, if the stock market narrative was valid, that prices were headed to new all-time highs, then oil should be following. It's not. There is a massive oversupply problem, and this downward 100-day moving average is going to act as resistance. So we're looking to get back down in here, maybe even possibly lower for an entry point. If we look at crude oil, you know, it got up to its 100-day moving average. You could make the argument, well, this is turning upwards. Yeah, if it gets down here and finds support, that's potentially bullish. But with the oversupply issue, and you have the secondary issue where price of oil is based on the monetary base. So as the Fed's tightening, it does bring, you know, trade down. And when you bring trade down, you bring the demand for oil down. So there's a bigger picture here of why oil is probably headed lower. But there should be an excellent opportunity to buy that as well at some point when it gets cheap enough. So let's take a look at the 7 to 10 year Treasury bonds, and they're just kind of consolidating right up in here. The 50-day is running up here, and the 50-day kind of tails off here. So this next week we're going to cut out these on the averages, and that's going to continue to push the 50-day moving average up, and it's going to act like support. And once this is all validated, you get this move, and I thought it would happen sooner, where it's just going to shoot up into here around this 106 to 107 range, but hopefully it's going to get all the way up here to 108, and this is the next major area of support. Looking at these 20-plus year Treasury bonds, they tagged their 50-day and held it on Thursday, took off today, ran into this overhead resistance zone where it struggled a little bit, and you can see it came up, touched it, seller, so we know the lines are correct. But this is bullish too. We have a rising 50-day, rising 100-day, and starting to rise 200-day. So again, there's lots of support showing down here that this is a valid bull trend. And what's kind of surprising, we're starting to see people come out and say the ags are so beat up and oversold that this thing's got nothing but upside. As of course we know for multiple reasons this is true. But what's interesting is you're seeing prices rising even as people come in and are trying to sell them. It's kind of unusual. You want to see prices rising with buyers, but hey, if people are seeing that this is battered, beat up, and dirt cheap, well, then you've got nothing but people to come in and buy. And if there is any deal with China, we know it has to deal with the farmers. So I'm pretty excited with what's going on in the gold market. I think, you know, because gold is tied at the hip right now with the equity market, we'll see when equities pull back, we should see golds pull back. And then at some point, we should see them decouple again. By that point, what ought to happen is treasury yields ought to be plummeting. And then you get this, once you get the risk off move, that's where gold takes off. So you kind of see, you know, you jump, we get into one, ride it, and then start cycling into the next thing. And I think that's pretty interesting what's coming. When you start looking at the bond market and the treasury market, or the treasury market and the gold market, you see something isn't right with the stock market. Something just doesn't make a whole lot of sense. So that's our update for the week. But I'm feeling that in the next couple of weeks, the setup is going to be complete for what we're looking for, and hopefully we'll see that massive return in the gold market. I'm Steven Van Metre. I'll see you soon. Bye now.